Once we know the debit and credit rules, we can finish journal entries for all the transactions. Once we have the transactions journal entries, we're going to post those numbers to the T account. For example, for the cash T account, I'm going to post all the numbers from this month's transactions, starting with a beginning balance. I have 2 debit, means 2 increase in cash. I have 3 credit, means I'm going to reduce cash 3 times. And from there, I'm going to have an ending balance. Right, this is the ending cash balance, which will be reported on the balance sheet. Okay, we call this posting journal entries to T account. This process, a very important process. And we know cash is an asset, and we expect to have a debit balance. We call this normal balance. And liabilities and equities, we expect them to have a credit balance. Those are normal balance for liabilities and credit. Liabilities and equities. Now we can see a few examples how we post journal entries to accounts. In this case, we issue stocks, right? We debit cash, credit common stock. Of course, if they have par values, we're going to credit additional paid-in capital, which we have explained that earlier. But in this case, if we debit cash and the credit common stock, see this journal entries, it's indented, okay? It's indented. The purpose is to differentiate a debit and a credit. Okay, first we start with the debit. It's indented, that must be a credit. So in this case, we debit cash, which means increase cash, increase asset, right? And this is equity. We're going to increase equity, that's a credit. So we know this column is a debit, this column is a credit, both are increase. So I'm going to post the cash to the T account, cash account. It's a debit post, and the credit is going to post to stockholders' equity, common stock on the credit side. Alright, so I've explained this, the rule of debit and credit, and why they are indented. So let's quickly go through other transactions. Right, borrow money by signing a note. So if we borrow money, we increase cash. So I'm going to debit cash, right? I also increase my liability. Remember, increased liability means a credit. So I credit note payables. Debit asset, debit cash, and a credit note payables for $1,000. And then post numbers to their account specifically. Sign rental agreement and I paid $1,800 security deposit. Okay, we paid cash, so we must reduce cash, so credit cash, and increase another asset, security deposit or prepaid rent. That's an asset. Increase asset, decrease asset. Right, purchase 2,000 inventory on account. We increase inventories and increase all liabilities. Account payables, $2,000. Right, these are advertisement expenses. We've talked about that. If we have expense, increase expense. Now, increase expense. Remember, expense is an equity account. However, it's going to reduce equities. So, expense account is going to share the same rule of asset. So increase expense, that's a debit. reduce asset, that's a credit. Okay. Next is we paid off our account payables. So we reduce liabilities. Remember, reducing liabilities, that's a debit, because increased liability will be credit. So we debit accounts payables, we reduce cash, so credit cash. All right. And here that's sales, right? Cash sales to customers. So we debit cash, credit revenues. Credit revenues means increase, and we're gonna, on the other hand, we're gonna debit an expense, cost of goods sold, right? Remember, cost of goods sold, like expense, it's gonna share the same rule as assets. So debit means increase. And this is the credit sales. That's the same thing. Increase accounts receivables, right? Other things will be the same. And this is the salary, wages payment. So increase an expense. Expense is the equity account, but it reduces equity, so it's going to share the same rule as asset. Increase in expense is a debit, and we reduce cash. This is the sale of membership. Remember, we increase asset cash. At the same time, we increase liabilities. Liabilities, that's increased liabilities, will be credit, right? Collections of account receivables. Increase cash, that's a debit. You reduce accounts receivable, an asset, that will be a credit. This is the payment of a loan and interest. We decrease our loan, a liability, that's a debit. Increase expense, that will be a debit as well. A reduce cash, that's a big credit. Prepaid insurance policies, both are assets. Increase one assets. Prepaid insurance, reduce cash, another asset. Right, this is a rent expense. Remember, expense, increased expense will be debit. And finally, that's pay the dividend. We can debit the dividend, credit cash. Dividend is going to reduce return earnings. So if we debit dividend, means increased dividend. We can debit return earnings directly, right? Debit return earnings means a reduce in return earnings, because eventually dividends is going to reduce return earnings in this case, and the credit cash. So after we recording these journal entries and posting all the journal entries, this is going to look like for the company's general ledger. A general ledger is like a book holding all the accounts. As you can see, all accounts are listed in this general ledger. So the general ledger is a very important place to get information, and from here we should be able to continue to work on the trial balance, and from there we have the financial statement. But now it's very clear that all these blue ones are assets account. We have their balance already. You just rearrange these accounts, and in balance we're going to have the we're going to have the balance sheet asset section already, and the same. The orange one, well, we're going to have the liability sections. Okay? And equities is a tricky. Equities. We have the stockholders equity balances for sure. We have the dividend. It's going to reduce return earnings, but that's not enough. we're going to update this return earnings from the income statement. Remember, income statement, all the revenues less all the expenses. Eventually, the net income is going to flow into this return earnings. Net income is going to increase the return earnings. And after we update that numbers, we complete the balance sheet. We have assets, liabilities, equities updated. From the green circles, all these accounts, we're going to have the income statement easily. And we're going to have the statement of stockholders' equity easily if we show the change in equity accounts. All right, so these are the basic knowledge for constructing financial statement. And this is just beginning. That's all for this lecture.